Carnival Corporation down 85.3%. I think it's a growth stock that you might regret not buying on this dip. I'm going to explain why I think that's the case in this video. I don't think you're going to want to miss it, so let's get right into it. First, looking at Carnival's revenue, of course, the company was devastated by the pandemic. It was forced to shut down its operations, and sailings were canceled for a longer time than many other businesses were forced to close. So, revenue collapsed from over 18 billion all the way down, falling to close to 1 or 2 billion, and before it really started to snap back, but still, it's not yet recovered back to its pre-pandemic levels. 12.17 billion annual revenue as of its most recent update. I fully expect Carnival to bounce back to levels before the pandemic and perhaps even higher than that as consumers unleash pent up demand for taking cruise trips, right? They haven't been able to take cruise trips for a considerable amount of time, and folks are going to start demanding and booking cruise ships. Already, management of Carnival has said that bookings have improved dramatically, and as another benefit, Carnival has implemented significant price increases, so people are paying higher prices to get back onto cruise ship sailings. And I suspect this is going to be the case for the next several years now because demand for travel, you might be surprised, has not recovered anywhere near where it was before the outbreak. So even though that's where consumer spending is shifting towards, right? We went from spending a lot of money on home electronics and things we do at home to now spending on things we do away from home. Travel hasn't recovered to the level before the outbreak. Carnival is one example of that, right? Their revenue hasn't bounced back to where it was before the outbreak. It's rebounding explosively. Look at that growth, right? But it's still not back to that level. Even in 2023, I don't expect it to bounce back to that level. Maybe in 2024 it will have recovered, and then in 2025 we can start to see revenue above where it was before the outbreak, because even at the same level of travel, if people are traveling the same amount as they did in 2019 in 2025, the revenues are going to be significantly higher because of inflation and because of price increases, right? Carnival has instituted several rounds of price increases. So revenue could be double digits higher than it was in 2019 at the same amount of people traveling. So that's going to be a tailwind for Carnival going forward. And you look at its cash flow from operations, Carnival was regularly delivering over $5 billion in cash flow from operations before the outbreak caused it to collapse, right? And it's recovering nicely, right, from from losses close to 10 billion up to almost breaking even. They lost only 70 million in cash flow from operations. In its next update, it could be positive. Definitely over the summer boom travel season, cash flow from operations are expected to be positive, and going forward it could be positive because people are booking trips more often. People are paying more for each trip booked, each room booked, and that's been a positive for Carnival going forward. Similarly, operating income over the trailing 12 months was consistently close to $4 billion in trailing 12-month operating income. That collapsed down to negative 8 billion, but that's been recovering nicely, negative $3 billion. Operating income may take longer to rebound to positive levels compared to cash flow from operations, but a significant amount of operating expenses is non-cash, namely depreciation expenses, non-cash expense. So it's cash flow from operations is going to be positive before operating income turns positive. But cash flow from operations is the more important figure because that's cash that's coming into the company and helping to reduce one of its biggest risks, which is total long-term debt, is a significant risk for Carnival Corporation. The company had to borrow a lot of money to sustain itself while it was shut down while it had to shut down cruises, total long-term debt jumped from close to $8 billion all the way up to $34 billion. So this is the biggest risk facing Carnival Corporation right now. It needs to really recover its cash flows to help it pay down some of this debt, because while it has this elevated level of debt, earnings are going to be pressured because it needs to pay all this interest expense on the debt. And this wasn't low cost debt. The company was in trouble, so it had to pay higher interest to get this debt. So the sooner it can recover cash flow from operations, the more of it can use to pay down debt, which will reduce interest expense, which will increase profits and cash flow, and so on. And that positive virtuous cycle can continue over the next several years, so long as this recovery in travel continues, this recovery in cruise demand continues, which I fully expect it will, because of all this pent-up demand for consumers. This is where people want to spend money right now. This is where people are spending money right now. You're looking at data, like data came out this morning for computers. In the first quarter of 2023, consumers bought 30% less computers than they did in the first quarter last year. 30% less. So where is that money going? That money is going to things like cruise travel, to hotel travel, to theme parks, to restaurants, things that people were not able to do as much of during the earlier stages of the pandemic. So we're seeing this recovery, and we're seeing it be persistent. That's good news for Carnival Corporation. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And the final reason why I say that you might regret not buying Carnival Corp on this dip here is because of this relatively cheap valuation. Carnival Corporation is trading at a price to earnings ratio of 5.8 right now. These are levels that you were not able to buy this stock at during any part of before the outbreak levels. Like, this stock was trading at valuations near 25, 26, even 16, 17, 18 before the outbreak. Now you're getting to buy this stock at near 1/3 to 1/5 the valuation it was at before the outbreak. Now that's justified, right? The company is in a much different position now than it was before the outbreak. It's got all this extra debt on the balance sheet. Its revenues are not yet back to where they were before the outbreak. It's still negative cash flow from operations. So this is to be expected, but it's just before the point where the company's going to bounce back, right? This summer and next summer, really pent up consumer demand is going to be unleashed in cruise travel, and you're going to be getting in right now just before the boom times. So and you're getting the stock at a very low valuation. That's already, in my opinion, accounting for the higher risk due to the higher debt and due to the different position the company is in. So for that reason, I think you might regret not buying Carnival stock down 85% off its highs. All right, that's all I've got for this video. Thank you so much for watching. I really appreciate your viewership, and I hope I'll see you again sometime soon.